Good morning. One of the topics that we want to talk about in a series of many videos that will be upcoming on our website and available through social media. A current thing that's going on is a lot of talk about the tax reform that's probably going to be passed here in the near future, affecting 2018 taxes in most part. With that being said, we're probably going to have some planning opportunities yet before the end of the year, and I wanted to just touch briefly on some of the things in the tax reform bill that is in the House and the Senate and going to committee. There's going to be potentially all of these things: an increased standard deduction, some type of change in the tax rates and brackets, potential reduction for some people in mortgage interest expense and potentially home equity loan interest. There should be or could be changes to the sale of residence laws. Deductibility of state and local income taxes is a big issue right now that they're trying to work through. Potentially a cap on the amount of property taxes that could be deducted. And with that being said, we're working on some strategies where it may be beneficial for our clients to prepay their state income taxes or real estate taxes before the end of the year, and we'll be in touch with you about that. There would be some limited casualty losses unless they're at federal disaster areas, changes to the estate tax laws, potential changes to the medical deduction, changes to alimony, changes for some educator deductions. Perhaps that will be better than worse. Also different amounts for child tax credits, changes to potentially student loan interest deduction, dependent care benefits and pre-tax dependent care benefits may be affected as well. Some of the other things that are changing for businesses and rentals would be like-kind exchanges. I think they're retaining the like-kind exchanges for real property, but maybe not in personal property, which would be business assets. Hopefully an expanded Section 179 deduction will help offset some of those changes there. AMT was removed in the House bill, but in the Senate bill it was retained. That's the alternative minimum tax, but with some different brackets as well and increases for inflation. One of the big concerns we have also is for our business clients who have pass-through entities. The two bills, the House and the Senate bill, are vastly different, but they do have changes for those pass-through entities, and that's something that we'll be staying on top of as well. The moving expenses change unless you're in the military. And another big one that we're concerned with is people who have substantial miscellaneous itemized deductions, like tax prep, investment fees, unreimbursed employee expenses. Those are very well going to change, and I think they're eliminated in both bills at this time. There are some other tax credits and things that we'll be monitoring, but please know that we're doing our best to stay on top of this information. If there's things that we need to do before the end of the year or questions you have, and you're one of our clients, please feel free to contact us at the office, and we look forward to working with you for better tax planning at the end of this year. Thank you.